There is the expectation that this could raise $800 million over 10 years. What do you think?
800 billion, yeah.
800 billion.
I think it has three attractive attributes. One you just named. The second is the dampening of the high-frequency trading, which creates more noise than I think information. And the third, it's a very progressive source of revenue. About 40% of the value of the stock market is held by the top 1% in terms of the wealth of the traders. And in that regard, it's a progressive revenue raiser, one reason Democrats like it. I do think that the impact on volumes would be a negative one. I think there's no question about that. The thing you want to ask yourself there is, would the diminished volumes be detrimental to trading, to price signals? I think the evidence there is that it would not. So I think this is a good tax. No tax is perfect, but I think it's a really good one.
Adam, your thoughts?
Yeah, these taxes have been tried around the world. They've been tried in France and in Italy. And every time they've been tried, we see that they don't work as intended. They actually increase stock market volatility. They simply don't raise as much revenue as people think they're going to, and they ultimately hurt everyone that's involved in the stock market. That's not just the rich, but that's you and I in our 401k. That's the teachers and firefighters who are invested through their pensions. And so everyone is impacted through this tax, and it simply just isn't an effective way to raise the revenue that folks are looking for.
Adam, what's happened to those attempts to try it in the past in places like France? Do they still exist? Have they been rolled back? These taxes are still out there, but all of the evidence, all of the academic looks at these show that they don't work on any of the margins that they are put out there. The UK also has one of these taxes. It's been around for a long time. And it's been estimated that cutting that tax rate in half is associated with a 10% increase in the stock market value in the UK. That's a pretty big hit.
Adam, when was that done?
This was an estimate of smaller changes in the rates, but
when was it cut?
Yeah. When was it cut?
The changes were in the 80s, but we've seen similar fluctuations in recent times in the introduction of these taxes in the UK and France in 2012. And each time we see that it has larger impacts than expected on the market as a whole, which does impact average investors.
Jared?
So we strongly disagree on the international evidence. I think much of what you just heard is extremely misleading. The UK has had an FTT, financial transaction tax, for literally hundreds of years, and it's been a global center of financial trading. Australia, Belgium, France, Italy, South Korea, Switzerland. And by the way, the USA, we have a tiny transaction tax here. It's what funds the SEC. And in all of these markets, you have fine liquidity, fine price signaling. As I said, I really do think this would seriously ding the highest volume traders, the high frequency folks. And many of them actually have transaction costs that are less than 10 basis points. So this would be a real game changer for them on the negative side. But if you believe that they create more noise than market signals, liquidity, patient kind of capital allocation, then that's another attribute of the tax. But I don't think you can possibly cite international evidence. There's one exception, Sweden. Sweden really screwed up their FTT, and it worked very badly. And that's because they had a high base. They had a high tax on a narrow base. What's being proposed today is a low tax on a wide base. And that's, by the way, what exists across the globe today.
Jared, you mentioned that you felt it was progressive, and I understand the reasons you gave for it. That said, there is an element of unfairness to this, that it's based on a transaction at a point of purchase, albeit a small tax at the point of purchase. Someone could go on to lose money in that transaction. Why, therefore, is not increasing capital gains tax not even more progressive? It's at a point of sale when you've already profited, and it's only on the profit, not the overall transaction price, which could then fall.
I think that's a great point, and I think that raising capital gains taxes so they're closer to the regular income rate would be a great advance. But it's going to take a lot of different ideas to raise the revenues we need. And I think if you're remember, we're talking about 10 basis points. Okay, so on a $1,000 trade, if I'm doing my arithmetic right, that's $1. And yes, you're right. There are some trades that lose money, but I think $1 on a $1,000 trade, a 10 basis point trade on a market that's trading, billions of trade a day. If that's going to take down the markets, we have much bigger problems than an FTT.
Well, that's true. And Jared, I mean, obviously, there are multiple layers of fees and market data fees that exchanges charge, all that kind of stuff. But the two different arguments here in favor of this tax, that it would dissuade some kind of noise trading, high volume noise trading, and also that it would raise revenue, seem a little bit in tension with each other, because the way it would discourage that trading is making it go away. And there would be less of that trading to earn revenue on.
Let me just point out that they may have been wrong about this, because these elasticities are hard to tease out. But the CBO score that got to the $780 billion that Becky mentioned did include diminished trading volume. So when you have something like 8 billion trades a day, you can lose some volume and still raise some revenue.
Adam, Jared's point at the top that a huge amount of wealth is concentrated in the stock market. You could throw in the argument that QE in the last decade has accentuated that and gone more to those people that hold stocks already as opposed to Main Street. Do you agree with that argument in general that suggests that people that hold stocks should face some form of extra tax? And if you do, is this financial transaction tax a better way of doing it in your eyes than some of the other proposals that we've seen out there?
No, I don't. I think that our tax system should be neutral towards investment and savings. And so that means that additional taxes on investment through the stock market or any other form should be as low as possible, that we should be taxing people when they spend their money on consumption, and that's the most efficient way to raise revenue. And so all of these taxes that raise the tax rate on people putting money into the stock market, into investing in new businesses, in new capital, all of these things slow the economy and ultimately make the average American worse off through lower wages, through fewer opportunities, fewer jobs. We saw this after the Tax Cuts and Jobs Act lowered the corporate tax rate, lowered taxes on capital, which has ultimately led to significantly more jobs being created. The economy has been picking up. All of this points to the benefits of lower taxes on savings and investment.
But a consumption tax, you think, would be fairer?
Yes, I think it would. I think that a tax that treats all consumption equally and doesn't discourage people from consuming later, which is what a tax on savings and investment does, would be the fairest tax system we could have.
Quick final word, Jared.
Well, I think that right there shows the difference between, I think, where both sides are coming from here, because a consumption tax, of course, would fall much more heavily on folks in the bottom half of the income scale because they consume a larger share of their income. And by the way, none of those folks own stocks. No, the stock ownership in the bottom half is almost non-existent. So again, progressive tax raises revenue, dampens noise trading. It's a good idea whose time has come.